Hi, everybody, and welcome back to video number 5 in chapter 7. And when we left off, we were looking at how easily a LIFO liquidation could distort net income and maybe lead to substantial tax payments. So here is a layer of LIFO inventory. So here's our base layer, and we added this, we added that, we added that in the subsequent years. Now, when we liquidate this, we're going to sell from the bottom up. Let's go back here. Here is our base layer. So we have our top layer here at 50,000. So that's our inventory. So when we sell, we're going to sell here. We're going to sell and keep. We're going to sell here, 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 and here, and keep 6,000 pounds remaining in inventory. And that means that we sold 2,000 out of that 8,000. And that's all going to go into our cost of goods sold here. The result is that our sales revenue are going to be pretty much our current prices, right? And that's going to generate a higher income and consequently probably a higher tax bill if we have to liquidate our inventory. Admittedly, that doesn't happen very often, but it is a risk using LIFO. All right, dollar value LIFO. The increases and decreases in a pool are measured in terms of dollar value, not physical quantity of goods. So a broader range of goods in the pool, that's an advantage. It permits the replacement of goods that are similar and helps protect the LIFO layers from erosion. Okay, let's take a look at that. Enrico Company first adopts the dollar value LIFO on December 31st, 2024. We'll call that the base period. The inventory at current prices on that date was $20,000. The inventory on December 31st at current prices is $26,400. Not surprisingly, the price of the inventory increased during the year. So in this case, the dollars went up 132%, a 32% increase during the year. Can we conclude that the quantities increased 32%? Not necessarily. To answer that, we need to determine the following. We determine the value of ending inventory in terms of beginning of the year prices, and we find that the prices have increased 20% during the year. The ending inventory at the beginning of the year amounts to 22,000 here. So we take the 26,400 divided by 20%, and that would take us back to beginning of year prices at current levels of quantity. And then, therefore, the quantity increased only 10% from 20,000 to 22,000 in terms of beginning of the year prices. The price of this real dollar quantity increase then of 2,000 valued at year-end prices is 2,400. That's 20% times 2,000. That's the same 20% from up here. This increment or layer of 2,400 was added to the beginning inventory of 20,000, and it totals 22,400 for December 31st, 2025. So the first layer was 20,000. The second layer, the 2025 increase in terms of 120, was 2,400, not 2,000. So the dollar value LIFO inventory was 22,400. So we can note that a layer forms only when the ending inventory at base year prices exceeds the beginning inventory at base year prices. Only when a new layer forms must Enrico compute a new index. Little complicated there, but I think you get it. All right, selecting a price index. Many companies use the general price level index the federal government publishes each month. I know I do. The most popular is the CPI, Consumer Price Index for urban customers, CPI-U. The companies here, companies also use more specific external price indexes if they have that situations, which I have had in certain situations. I can remember for stainless steel, for example, it was all over the place at one point in time. In any event, the company may compute its own specific internal price index here by taking inventory at current cost versus ending inventory at base cost. And that'll give you your price index for the current year. All right, the double extension method is illustrated here. Sweet sock companies base year inventory starting January 1, 2025 had the following items. Here we have some wool socks and some cashmere socks, quantities, costs, and dollars. We examine the ending inventory and we have 3,000 pair of wool socks and 6,000 pairs of cashmere socks. The most recent actual purchases are related to those items. So here we purchased 4,000 of these wool socks at $7. And then cashmere, we had 2 purchases there for 5,000 and 1,000 for $25 and $22. So now, if we double extension method here, our wool 3,000 units and 6,000, our base year costs were $6 and $20. You'll remember here, right? Now we've upped that to the ending inventory here of $3,000 and $6,000. But now that's going to be valued at the base year costs, but the actual units for 138,000. So we do the same thing here for our current cost and we get 168,000. So after they're double extended, we can compute the price index simply by taking this 168,000 divided by this 138,000 for 121.74. We can then apply this index to the layer that we added in 2025. And we can note that it used the most recent actual purchases to determine that current cost. Alternatively, it could have used other approaches such as FIFO and average cost. But whichever flow assumption is adopted, the company must use it consistently from one period to another. And it's very unlikely that your outside auditors would agree to a change in cost flow assumption merely to save taxes. So we also have a principle of consistency. And so that's, you would have to prove that a change in cost flow assumption improves reporting. Impossible to do in my view. So pretty much you're stuck with what you're doing. Okay, so the specific goods LIFO, those are costing goods on a unit basis, is expensive and time consuming. Well, practically I've never seen that done. Specific goods pooled LIFO approaches, that definitely will reduce your record keeping and clerical costs it's more difficult to erode the layers, and using quantities as a measurement basis can lead to untimely LIFO liquidations. But dollar value LIFO is used by most companies. In my experience, all of the ones for which I have worked. All right, the major advantages of LIFO then, we match the recent cost with the recent revenues, tax benefits, that's the reason companies adopt this, let's be frank, and improved cash flow as a result. And it's a future earnings hedge, meaning we're going to have a advantage from having the money today. The major disadvantages is it certainly reduces your earnings. That's fine. The inventory is understated. The physical flow is not how most companies' physical flow would work. And in the event of involuntary liquidation, poor buying habits, that's going to distort LIFO even more. Okay, use the dollar value LIFO method. Here, the good old Truman Company uses dollar value LIFO method of computing its inventory. The inventory for the last 3 years is as follows. So here they are, boom, 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 and inventory, boom, 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 and price index, boom, boom, boom. Now, what are the values of the 2023, 2024, and 2025 inventories using the dollar value LIFO method? Well, here's what we would do. Let's go back real quickly. Here's our 60,000, 84,000, 87,000. And here's those same numbers. We're going to adjust those for the price indexes. And then we'll base our layers on that. And as indicated, it's consistent with LIFO costing in times of rising prices. The dollar value LIFO inventory amount is less than the inventory stated at end of year prices. The company did not add layers at the 2025 prices. This is because the increases in inventory at the end of year current prices was due to higher prices. Also, establishing the LIFO layers based on price adjusted dollars relative to base year layers reduces the likelihood of a LIFO liquidation, thereby preserving the cash flow benefits of using LIFO. Okay. I think you can see from that why IFRS does not allow LIFO. I don't think, and I think I agree with IFRS. LIFO is, it distorts things more, I think, than it helps things. But it does save income tax. Okay, so now we'll take a look at determining the effects of inventory errors on financial statements. And here, you'll remember that we start with beginning inventory plus purchases minus ending inventory gives us our cost of goods sold. So if we use that formula, if we understate inventory, right, that's going to overstate cost of goods sold. Understating retained earnings, working capital, and current ratio will understate net income. And the effects of an error on net income in one year will be counterbalanced in the next. However, the income statement will be misstated for both years, but correct over the course of 2 years. That looks like a good place to stop this video. And when we come back, we'll finish this chapter by illustrating how inventory can be misstated. Until that time, bye for now.